Good morning, everyone, and welcome to the 21st annual conference of the Central Bank of Chile. A special thanks to those that come from far away. Being in Chile, that means almost everyone that is not Chilean. And it is a pleasure to host this event that every year gives us an opportunity to reflect and discuss about the issues that have direct implications on our work as central bankers from a broader perspective. I'm looking forward to an active discussion through the rest of the week on this year's conference, particularly given it's a very relevant theme to everybody, monetary policy and financial stability. I'm sure that we will have a very rich discussion. We have a very nice set of papers, and we should thank particularly to the lineup that we have here that will be presenting some of these studies. 10 years have passed since the onset of the global financial crisis, and we're still dealing with its economic consequences. Academics and policymakers have learned a lot, and a decade of hindsight about the causes and long-lasting effects has led us to rethink the way to conduct monetary policy, how to ensure financial stability, and how these two elements are or should be interconnected. Nothing better than a good crisis to shake and all establish the practices, and certainly this has been one of those cases. One of the most important policy lessons from the crisis concerns the relevance of actively seeking financial stability in a context of ever-increasing financial complexity. And central banks worldwide have been increasingly involved in assuring this, since it has become clear that financial stability is a precondition for price stability. Financial stability has long been a key concern for policymakers, particularly in emerging countries, where financial vulnerabilities are or were more evident and where risks to stability often come from abroad. Nowadays, the key concern is how to act in a preemptive way with actions that are costly to ensure financial stability into the future. How should macroeconomic policy pursue the goal of financial stability in normal times when the benefits are uncertain but the costs are noticeable? And in the case of emerging countries, to this perhaps we should also add how to pursue financial stability while at the same time we are pursuing financial deepening, which is necessary for our development. As many of you know well, this concern came with the observation that the build-up of risks in the United States before the crisis occurred during a period of stable prices and output, the so-called Great Moderation period, where low nominal interest rates that were consistent with the central bank's commitment with CPI inflation stability may have led to excessive risk-taking by financial intermediaries and to a rise in asset prices, while good economic conditions masked the developing of financial imbalances. In the aftermath of the crisis, policy rates were drastically reduced and diverse policy measures were implemented as the zero lower bound became an active constraint. But the increasing concern about financial conditions and the consequent reassessment of the macroeconomic policy framework was most evident with the adoption of macroprudential policies. But the question remains about the role of monetary policy. Should monetary policy frameworks explicitly incorporate risks to financial stability? This, the so-called leaning against the wind debate, has become one of the most hotly debated issues in macroeconomics, in policy as well as academic circles, and will be one of the main topics that we will discuss and learn about during these couple of days. Let me contribute to this debate with the perspective of a policymaker in a small open economy like Chile. In our case, financial vulnerabilities have been often related to large and volatile capital flows with their consequent effects on asset prices and credit spreads. In this context, raising the interest rate in normal times due to financial stability concerns as a leaning against the wind strategy would prescribe may be counterproductive, as it would attract more capital flows, would tend to appreciate the domestic currency, and would encourage foreign currency borrowing. These mechanisms, of course, have been at the core of monetary policy in developing countries for many years. In the case of Chile, they were more evident during the 1990s, when capital controls were in place to try to give more autonomy to monetary policy in a context of persistent and large capital inflows. However, these mechanisms were relevant as well when debating about the role of monetary policy in actively pursuing an objective of financial stability. A second issue I would like to point out is related to the credibility of the central bank, which is also a very important concern for emerging countries like Chile, where credibility has gained over several decades of responsible policy making, and losing it would mean a costly institutional setback. A strong advantage of having monetary policy focusing exclusively on price stability is that it simplifies communication and enhances accountability, while the resulting positive effects on credibility. Adding a different objective would hinder transparency, endangering the anchoring of inflation expectations. However, independently of the convenience of following leaning against the wind strategy or keeping the pre-crisis consensus with monetary policy focusing primarily on price stability, I am convinced that the main lesson from the crisis is that regulatory frameworks aimed at specific sectors and markets are a key element of a defense against financial disruptions. Macroprudential policies, and in particular monetary policy, are not substitutes for an efficient regulatory framework. Microeconomic policies can be targeted much closer to the source of market imperfections, mitigating their effects while at the same time avoiding the economic-wide costs of contractionary macroeconomic policies. We cannot forget that inefficiencies in the regulatory framework were at the heart of the build-up of risks in the run-up of the crisis. The fact that fragilities in the financial system, namely inadequate levels of capitalization and liquidity, were not properly and timely identified, may primarily reflect inadequacies in regulation and supervision. Our best response is to continue strengthening regulation and supervision regimes aimed at avoiding future crises. And central banks have a crucial role to play because there are clear complementarities between financial and monetary stability, which, as in the case of Chile, are often formally recognized in central banks' official mandates. Before referring to what we have done with this matter in Chile, let me briefly describe our experience with the global financial crisis and our macroeconomic policy response to it. While we were still enjoying the commodity boom of the 2000s, we were hit by the spillover effects of the crisis and its aftermath, namely the tightening of domestic lending conditions, capital outflows, a reduction of the external demand for our exports, and a decrease in the price of copper, which is still the main source of external income for the Chilean economy, and in particular an important source of revenue to the government. The price of this critical commodity fell more than 60% in just 5 months. Exports fell almost 20% in 2 years, a strong shock for an economy where exports accounted for more than 40% of the GDP. A similar drop experienced public revenues, while those coming from copper production falling by 23% in 2008 and 50% in the following year. Despite the severity of the shocks, economic performance and the resilience of the financial system have been better than in comparable situations in the past. Behind this favorable response of the Chilean economy lies a macroeconomic policy framework able to pursue an effective reaction and a regulatory scheme supporting the high resilience of the domestic financial system. In Chile, the monetary policy framework consists of an inflation targeting regime with floating exchange rate. This framework has allowed us to respond efficiently to external shocks, keeping inflation expectations anchored. Before the Asian crisis of 1998, we had a managed exchange rate, and we had capital controls in place to allow monetary policy independence to manage inflation in a context of abundant capital inflows. Indeed, we experienced a costly adjustment to that episode, and this was fueled in part by financial stability concerns that called against an exchange rate adjustment by the end of the 1990s. But once the harder times had passed, The exchange rate was allowed to float freely, facilitating not only the external adjustment against the shocks, but also improving the incentives for private agents to properly hedge their foreign currency operations. The deep-rooted credibility of our central bank has also facilitated the conduct of monetary policy with a floating exchange rate system. The fact that the market understands that the central bank pursues a goal for inflation at a 24-month scenario means that the exchange rate pass-through to inflation is relatively low, one of the lowest in the region, actually. This can be illustrated with the reluctance of the central bank to tighten monetary policy in 2015, despite a 49% devaluation in 2014-2016, and without affecting 24 months ahead inflation expectations, which remained anchored at the target level. As the 2007 financial crisis unfolded and its effects spread out, this framework helped us to avoid large costs and evade financial problems despite our strong ties with the global economy. In the aftermath of the crisis, the local currency depreciated around 45% in 7 months, while the monetary policy rate was reduced from a relatively high level of 8.25% in December 2008 to a 0.5% in July 2009, remaining there for about a year. Together with lowering the interest rate, the central bank implemented a program of liquidity provision that significantly reduced the market interest rates to a level much closer to the monetary policy rate. Additionally, in the middle of 2009, it established a term liquidity facility for banking institutions, granting 90 and 180-day liquidity at the prevailing monetary policy rate, signaling a more expansionary path for the monetary policy rate than the market expected. The active monetary policy response, together with an expansionary fiscal policy, favored a healthy fiscal position that was achieved thanks to a fiscal rule where expenditures are determined as a function of long-run copper prices and economic growth, the so-called structural balance rule, facilitated the rapid adjustment. After only one period of negative annual growth in 2009, the economy was able to sustain growth rates above 4% in the years that followed. The inflation rate fell well below the target range for about a year, but inflation expectations, again, remain well anchored at our target of 3% in the 2-year horizon. Undoubtedly, this is the strongest counter-cyclical macroeconomic policy response we have ever implemented to a shock of this magnitude, and it was possible thanks to a sound corporate sector, a well-capitalized and resilient financial sector, and a solid position in terms of international liquidity. Importantly for the discussion ahead, this was the result of careful regulation and supervision of individual financial institutions. This scheme hails back to the banking crisis of the 1980s, and it has been constantly adapted and improved since then. In Chile, financial services are regulated and supervised by different institutions according to the type of service. Securities and insurance, the pension system and unemployment insurance, and banks. In the case of banks, the superintendents of banks and financial institutions and the central banks are in charge. Different schemes have been designed to facilitate coordination between institutions. This effort has led recently to the creation of the Financial Market Commission, which will be headed by an autonomous board of directors and will transform the financial supervision and regulation scheme to an integrated one with a systemic view of the stability and risks facing the financial sector and more flexibility to deal with critical situations. The Central Bank of Chile enjoys a special independent status under the bank's constitutional organic law. Besides specific regulatory tasks with regard to the banking sector, the central bank oversees the foreign exchange regulations and monitors closely and constantly all the industries making up the financial sector. A central task performed by the central bank aimed at financial stability is the publication of the Financial Stability Report twice a year that will be released in just a couple of weeks. The banking regulation has evolved gradually and steadily. adopting proven international standards and best practices. A new general banking law will provide for a gradual convergence to the Basel III framework, which will raise the quality, consistency, and transparency of the capital base, strengthen risk hedging, introduce leverage limits, promote a countercyclical capital framework, and introduce a global liquidity standard. This bill is currently under discussion in the Chilean Congress. These requirements will be implemented gradually through 2019. They will provide higher stability and sustainability and contribute to Chile's reputation and access to international markets. Chile largely complies with the principles for financial market infrastructure established by the BIS as well. An assessment made by the World Bank and the IMF last year identified a high level of compliance with the principles on the part of the entities assessed, as well as the authorities. The main conclusion was that Chile has sound and robust financial market infrastructures in line with international standards and best practices on risk management, the finality and irrevocability of settlement, efficiency, and transparency. The Chilean financial market is in general deeper than those of other Latin American countries with larger institutional investors and greater maturity. Banks' capital adequacy indicators are similar to those of other economies in the region, but lower than in OECD countries, and that's partly the justification for this banking law reform. The World Economic Forum Banking Strength Index shows that the Chilean banking sector is very strong, as it ranks in the 11th place in the world. Let me finish by pointing out the relevance and that the exchange rate derivatives market has had in favoring both financial stability and the conduct of the flexible inflation targeting scheme in Chile. This market is not as deep as it is in developed countries, but it has experienced significant growth of more than tenfold since 1998, fueled in part, as I already mentioned, by the floating exchange rate regime. The role of pension funds has been significant as well, as they maintain a large positive foreign financial position and keep hedging against exchange rate risk even above the regulatory requirements, especially in the aftermath of the last crisis. And this provides an adequate match to the hedging needs of corporations. Thanks to these factors and a favorable regulation, Chile shows a high level of penetration of financial derivatives compared to other emerging economies and countries in the region. All this has contributed to a limited exchange rate mismatch of corporations. Today, the share of firms with a mismatch of over 10% of their assets is below 10%, down from around 20% before the crisis. Hence, monetary policy can be conducted in a countercyclical manner without the need to manage the exchange rate. However, as the recent experience in developed countries has revealed, the rapid development of derivative markets also poses challenges to regulators due to the complexity and potential concentration of risks in a few entities. An additional strength of the Chilean economy in the context of emerging countries, which I think is very important for the topic to be discussed during these days, is the relevance of institutional investors, in particular pension funds. Their role in financial stability has gone well beyond the development of the derivatives markets that I mentioned. They have contributed to the deepening of capital markets, portfolio diversification, and the development of new financial products, among other features. Moreover, with their peso-denominated liabilities and large foreign position, which is around 35% of GDP in the case of pension funds, they have facilitated the conduct of monetary policy, being an important source of liquidity in foreign currency when needed. Acknowledging this, the financial regulation has gradually expanded the scope of possible investments for institutional investors, including raising the limits for investments abroad. So the issue here is not just the size of institutional investors, but also the fact that institutional investors are allowed and are very active investing abroad. Let me finish by thanking the distinguished group of economists that have joined us to present and discuss issues concerning monetary policy and financial stability. I would particularly like to thank also Álvaro Aguirre, Marcus Brunnermeier, Diego Saravia, and Catarina Larraín for putting together the program, and Paloma Navarro and Carola Besa for helping with the organization. So thank you very much, and have a good couple of days of this conference. Thank you.